Welcome to the Deep Dive, where we break down the latest earnings calls. Today, it's Victoria's Secret & Company's Q2 FY 2025 earnings, released August 28th. And this one was, well, a bit of a head-scratcher. Really strong Q2 numbers, beating expectations, but then also some serious headwinds flagged for the rest of the year. Market reaction. Pretty choppy.
Yeah, exactly. You had that first blush of excitement, with the headline figures. Stock looked good pre-market, but then the details started sinking in, especially around future guidance and, importantly, tariffs. Investor mood got, let's say, a lot more cautious pretty quickly. So today, we'll dig into why those signals felt so crossed and what it really means for VSU going forward.
Okay, let's kick off with those headline numbers because they were genuinely impressive for Q2. Victoria's Secret delivered adjusted EPS of 0.33 cents, which, compared to the consensus estimate of around 13 cents, is a pretty significant beat.
Huge beat, yeah.
And revenue came in at $1.459 billion. That also topped the roughly $1.41 billion consensus. So solid top-line growth, up 3% year over year, and comparable sales were up 4%. Good momentum there.
Right, and it wasn't just sales. Gross margin actually ticked up slightly by 20 basis points year over year to 35.6%. Management put that down to what they called promo discipline, basically being smarter about discounts.
Less discounting, better margins. Makes sense.
Exactly. And adjusted operating income reached $55 million. That was a good $20 million better than their own forecast. What's really notable is they managed this even while absorbing an estimated $14 million hit from that cyber incident back in May.
Yes, I remember that incident.
So yeah, overall, pretty strong internal performance numbers that definitely grabbed attention initially.
Okay, strong headlines. But yeah, the devil's off into the details. Let's take a bit deeper. Beyond those main figures, where did Victoria's Secret really shine in Q2? And maybe where were the cracks starting to show?
Well, it gets interesting when you look at the different parts of the business. North American stores, they saw a decent 3.1% sales lift, kind of steady. But the real story, the standout performer, was the international business.
Oh yeah, how much?
Sales surged almost 22%, 21.8% to be precise. Retail comps that were up high single digits, especially strong performance in China, it seems, driven a lot by their digital effort.
Okay, so international booming. What about online, the direct channel?
That was a weaker spot. Direct channel sales actually fell 5.5%. Management did partly attribute that to the cyber incident in May. They estimated it hit net sales by about $20 million. So yeah, a bit uneven across channels and regions, but international was definitely the highlight.
Hillary Super, the CEO, she talked about momentum from product innovation, newness, and evolved storytelling. She mentioned that new body by Victoria FlexFactor bra launch, the one with the titanium underwire. Did that actually move the needle?
It seems like it did, actually. That FlexFactor launch was pretty significant. It drove double-digit growth in new customers in the last week of July.
Double digits.
Wow.
Yeah, right when the campaign hit. It signals that their push towards, these elevated basics and focusing on full price selling is working. It's attracting fresh eyes.
And Pink, the younger brand.
Pink's getting a repositioning, more of a lifestyle brand for the 18 to 24 crowd. Very digital, very social first. And that Love Shack Fancy collaboration they did, apparently a record breaker. Huge results, zero discounting.
Zero discounting. That's impressive. Shows real demand.
Totally. It shows pricing power, product desirability, and it also shows they're getting faster. They brought that collab to market in just 26 weeks.
26 weeks. That's quick.
Yeah, it used to take them more like 52 weeks. So that operational agility is definitely improving, almost fast fashion speed there.
And the beauty segment. That's usually a reliable performer for them. Absolutely. Still going strong. Beauty had its 8th straight quarter of growth. Mid-single-digit sales increases across the board. It's a big deal for them, a billion-dollar domestic business. And they see a lot more room to grow there, saying the U.S. beauty market is like 4 times the size of the intimates market.
Wow, okay.
And one other sort of background point, they renewed their ABL credit facility back in May, got a 5-year extension, better terms, lower interest rates.
So good financial flexibility.
Exactly. Crucial in retail right now. Provides liquidity, stability. It's a quiet win, but important.
Okay, so Q2 paints a picture of a brand finding its footing again, some real positive momentum. But then we hit the forward guidance. This is where things get, well, complicated. For the full fiscal year 2025, they actually raised the sales outlook, now expecting $6.33 billion to $6.41 billion. That's up from the previous $6.2 to $6.3 billion range. So confidence in continued sales growth.
Right. But here's the kicker. Despite raising the sales forecast, they kept their adjusted operating income guidance exactly the same for the full year, still targeting $270 million to $320 million.
Huh. Higher sales, but same profit target? What gives?
Tariffs. That's the big elephant in the room. They updated their estimate for the tariff headwind, and it's now expected to be about $100 million for the full year.
$100 million. Wasn't it lower before?
Yeah, it's a $50 million increase from what they previously assumed, reflecting 30% tariffs for China and 20% for non-China imports. That's a huge bite out of potential profits.
Ouch. And that hits Q3 particularly hard, the quarter we're in now.
Exactly. For Q3, they're guiding sales between $1.39 and $1.42 billion, which seems okay. But they're projecting an adjusted operating loss of between $35 million and $55 million.
A loss?
And an adjusted EPS loss of medical $1.55 to netical 75 cents per share. So yeah, Q3 looks rough on the bottom line. It's mostly that tariff pressure, about $20 million impact just in Q3, plus some planned marketing investments.
So that really begs the question, can their strategies actually offset these big external cost hits in the near term?
That's the multi-million-dollar question, isn't it?
$100 million tariff hit for the year. What are they actually doing about it? What are the mitigation plans?
They outlined a few key strategies, trying to optimize costs with vendors, number one. Number two, diversifying sourcing, moving production out of those high tariff regions where possible, and managing freight mix, shifting more from expensive air freight to ocean freight.
Okay, standard playbook stuff. Pricing.
Yeah, they mentioned select pricing adjustments too, through targeted promotions and maybe some strategic price tweaks, trying to keep the value proposition. But they were also pretty clear. Most of the big benefits from these actions, especially sourcing shifts and freight changes, won't really show up until FY26.
So not much relief this fiscal year.
Not significant relief, no. FY25 mitigation is mostly locked in. It's more about setting up for next year.
Got it. They keep mentioning their path to potential strategy. What exactly does that involve? Is it just buzzwords, or are there concrete pillars?
It seems pretty concrete, actually, and ties back to what we saw in Q2. Pillar one is supercharging bra authority. Think FlexFactor, continuous innovation there. Pillar two is recommitting to pink as that lifestyle brand for young adults. The Love Shack fancy success fits right in.
Okay.
Pillar three is fueling growth in beauty, which we already discussed, given its consistent performance. And the fourth pillar is about evolving their overall brand image and how they go to market, reflecting cultural shifts.
Making the brand more relevant.
Exactly. And they're backing it up with big initiatives. The return of the Victoria's Secret fashion show is set for October 15th. That's huge visibility.
Definitely generates buzz.
Plus, new sports bras launching in September, a tiered gifting approach for the holidays to capture different price points. And underlying it all is this message shift. Sexy isn't a singular look, it's a feeling, trying to broaden that appeal.
Right, moving beyond the old image. Okay, so you've got this internal strategy, product wins, against major external headwinds. How did the market process all this? You said choppy.
Very choppy. Pre-market, right after the release, the stock jumped up around 7.6% to 8.65%. Looked quite positive.
But that didn't last.
Nope. During the main trading day, that initial pop, which was around 10% at one point, just evaporated. The stock actually finished the day down 0.5%.
Down 0.5% after that initial surge. Wild.
Yeah, and look at the volume. 8.48 million shares traded. The average is usually around 3.45 million. So a lot of activity, a lot of debate. Investors were clearly wrestling with it.
Balancing the good Q2 against the tariff pain and the Q3 loss forecast.
Precisely. You see the internal stuff working the product, the disciplined promotions, driving sales, that's positive. But the external environment, specifically those tariffs, is just a massive counterweight right now.
So the fact they reiterated the full year operating income guidance, even with $50 million more in tariffs, that suggests they think the core business can absorb some of it.
That seems to be management's message. They see enough underlying strength to offset some, but not all, of that tariff impact. But the market's reaction says, show me. They want to see proof that the mitigation works, especially with activist investors watching and the whole retail sector being cautious about spending.
Okay, makes sense. Which brings us perfectly to our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea based on everything we've just discussed. What have you got?
All right. Given this whole dynamic, the strong Q2 overshadowed by Q3 tariff woes and the market's hesitation, here's a contrarian thought. Consider initiating a long position in Victoria's Secret, VSU, maybe towards the end of Q3 or early Q4. But And here's the hedge. Couple it with a short position in a broad retail ETF, something like XRT.
Okay, long VSQ after they just guided for a Q3 loss. That definitely hits the outrageous criteria. What's the plausible part?
The plausible part is betting on patience and looking ahead to FY26. Management was pretty explicit that the real benefits of tariff mitigation sourcing shifts, ocean freight take time but will ramp up next year. The market seems hyper-focused on the immediate Q3 pain. But look at Q2 FlexFactor, Love Shack Fancy that shows genuine brand heat and pricing power isn't dead.
Right. The underlying business showed strength.
And they raised the full-year sales guide despite the tariffs. That signals some confidence. So the idea is you buy in maybe when sentiment is lowest around the Q3 results, betting that the path to potential, the fashion show buzz, holiday, new products combined with those delayed mitigation efforts starts to really improve margins in FY26.
And shorting the retail ETF.
That's the hedge. If the whole retail sector stays weak due to macro concerns, the short XRT position helps cushion against that, isolating the potential upside specifically from VSCO's turnaround and eventual tariff relief. It's a bet on VSCO outperforming the broader sector if their specific plans work out.
Interesting. A play on delayed gratification and specific execution against a broader cautious backdrop.
Exactly. High risk. Sure. Plausible based on the call. I think so.
All right. There you have it. A fascinating deep dive into Victoria's Secret's Q2 FY 2025 call. Strong beats on the top and bottom lines for Q2, clear signs of product and marketing working, but undeniably overshadowed by a tough Q3 outlook thanks to those significantly increased tariff pressures.
Yeah, management is projecting confidence in their long-term path to potential strategy. We saw real evidence of that in Q2 wins. But the market, clearly focused on the near-term financial hit from tariffs. Progress on mitigation and continued brand momentum will be absolutely key to watch. And beyond just tariffs, it's about whether this brand evolution can truly stick and drive profitable growth long-term. That's the bigger picture.
Absolutely. And remember, everyone, this discussion is purely for informational purposes. It is definitely not financial advice. Always do your own thorough research before making any investment decisions. We hope this breakdown gave you a clearer perspective. Until next time, stay informed and keep diving deep.